Hello, everyone. Welcome to the market update for Tuesday, October the 4th. As always, if you have any questions during the week or any questions I don't get to in the live class here, make sure you send those to jerry@traderspro.com. And if you forget to write that down, it will be recorded, so you can just go view the recording and see the first slide there and write that down. By the way, you can access the recording of these updates on the YouTube channel. If you go to youtube.com, type in Traders Pro, join the channel or what have you, you can get access to those the recordings of these updates. All right, let's get started. Obviously, we're seeing a market rally today, and this is something that, well, the timing of it is weird because how we closed on Friday, we closed below the June lows, but it goes back to the back and forth argument we were having last week, which was the market is very oversold. We're due to have some sort of an oversold bounce, but we're also at a level where all hell could break loose, so we could have that panic sell-off that we've been kind of waiting for. And I don't like those trading conditions because you're dealing with very low probability conditions at that point. You're almost trying to guess what's going to happen next. And when you have a good argument for the market going up as well as going down from a particular spot, that's not a good place to be getting aggressive or to do a whole lot. That's usually a sign that you want to sit back and do nothing. Or if you are going to do something, make sure you're kind of hedged in what you're doing. And that's kind of what I did with the portfolio. Is we did have trades we got into, but I also was hedged a little bit. The problem with that is that you don't make very much money because what you're making on one end, you're giving back on the other. But it allows you to hopefully do something while you're waiting for conditions to improve and still make a little bit of money in the process. And that's usually the goal or objective when we're in these types of conditions. It's important to, again, I know we don't talk about this very often because it's a long-term indicator, but it's important to recognize that we're still in a bear market. We're at the far left side of the indicator right here, which means that we're probably getting closer to a bottom or we're near a bottom. But you can't just assume that means that we're at the bottom because, well, for instance, we were at the far right side of the bull market indicator for over a year. That the market kept going higher and higher, and we were at that extreme level. Now we were experiencing conditions. We were experiencing the strongest bull market that we've ever seen in history. So, it was one of those outliers or unique situations where, you're not likely to see that happen again. But it was important to recognize that although that longer term trend at the time was still showing a strong bull market, you didn't want to be shorting stocks just simply because you're at the far right side of that. And that's the same case here. We don't want to be buying stocks just because we're at the far left side, but we want to recognize that we're in that bear market condition. Why is that important to recognize that? Well, in an uptrend, what you're doing is you're buying the dips. Every time the market moves up and it pulls back, you're buying on those pullbacks. And the term is called buying the dips. And that's what works. Okay. It works, and many of you have been conditioned to doing that because if you've been trading over the last 5 years or so, it's worked every time. Every time the market pulled back, you buy in and it goes back higher. And if you're brand new to trading, that's all you've known. You've never seen the opposite of that, which is within a downtrend, it's the opposite. You'll get these snapback rallies, but they lead to bigger moves down. The bigger trend is down, These are just rallies within the downtrend. And this term that they use is sell the rips, meaning it usually rips higher very quickly, kind of what we saw in the last couple of days. And then usually you end up going lower, and it's just the opposite. So you can see the problem if you're buying the dip still, you're buying down here, and then it's rallying, but it's not rallying very much, and then you're getting killed when it makes that next sudden move down. And if you're still buying on all these downward moves, you're buying here, it fails, you're buying here, it fails, you're buying here, it fails, you're losing a ton of money trying to use that same approach that you've been using for the last 5 years. And you're confused because you're saying, boy, it's worked over the last, as long as I've been trading, it's worked. What's going on right now? Well, it's just a recognition that you're in a different market. You got to recognize you're in a different market. And the purpose of the software is to kind of force you to change that mentality. We have a tendency to latch onto our biases and our beliefs, and we look for only reasons to reinforce those beliefs. And so if I'm very bullish in the market, I'm looking for every little reason to be bullish. That means there could be 10 people on TV telling me good reasons why the market's going down, but there's one guy that says he thinks it's going to go up, and I'm going to listen to him, and that's all I'm going to listen to because he agrees with what I want. Every person does this, by the way, because we're human beings, and when we talk about human nature in the markets, this is what we're talking about. These are natural tendencies for us to kind of latch on to our biases and our beliefs, and look for reasons to believe that. Now, there's another thing that attaches to this, which is that you also got money involved. You're putting money at risk. So if I'm buying a stock and there's negative news on that stock, or there's reasons why that stock can go down, that's going to be painful to me. That's going to hurt me. That's going to cause me to lose money. And so I don't want to hear it. I don't want to listen to that. I want to listen to some guy that likes my trade and likes my stock and believes that my stock is going to go higher. But you see, the problem with that is that if you're ignoring what the chart is telling you, what the facts are telling you, then you're going to get into trouble. You're going to be buying each of these little dips in the downtrend instead of selling the rips, and you're going to get yourself into trouble. So it's important I know we brush through these indicators very quickly a lot of times, but especially for those that are new, it's important to pay attention to them because they're telling you the conditions that you're in. We're in a bear market. You have to incorporate bear market strategies. You want to be mostly in cash, or you want to make sure you're very selective on what you're buying, the stocks that are outperforming within the downtrend. Or, I've talked about, sectors like oil, energy that's been rallying for the most part within this downtrend. It's had its ups and downs, but we've seen it kind of, especially in the early part of the drop, it was rallying, it was going up. This is what was working, was energy trades. Right now you're seeing things like consumer staples, the stuff that people have to buy every day, whether the economic conditions are good or bad, or whether inflation is high or low. You still got to buy shampoo and soap and shaving cream and all that kind of stuff. So those stocks are working right now. But again, it's important to recognize the conditions that you're in. Now, with the rally yesterday, now this will update overnight, so some of these will change when the market updates overnight. They'll move probably further to the right here. Momentum right here has come off of the extreme range. It was down there in the extreme range. It'll probably move closer either to the far left side of that cell, or maybe even in the hold range when it updates. Well, assuming the market closes at these levels here, it could fade a little bit. It's already faded a little bit off the highs of the day. We'll take a look at those charts here in just a second, but it's basically alleviating that oversold condition. And if we have another positive close today, it'll at least, it won't have alleviated it completely. We've had such a drop that we could still rally up a little bit further. But we're going to take a look at some of the trend lines when we get to the charts of where to look at where we might rally to. But that's what we're looking for. We're expecting that we're still in this downtrend. We're still stair stepping down. what we're trying to analyze when we're looking at the charts is how far we think we'll rally before we could have another downturn and move lower and continue that downward trend. But so we've alleviated a little bit of that oversold condition. Now there were a couple of comments, and I was going to bring this up. The breadth indicator is missing its little box right up here. It's the programmers are working on something on the site, and that's what I was told, is that there are a couple glitches there while they're fixing something. Sometimes when you fix one thing, it causes a problem somewhere else, so that'll get fixed. But I can tell you, breadth and momentum have been moving pretty close together, so I would assume the breadth indicator is probably in the same area. Might even be a little bit closer to the hold range when that thing comes back up. So anyway, so that'll come back on. There was another glitch I'll point out here too that we'll take a look at. The sentiment indicator is still high and moved back into the extreme range. And this is again, this is a signal as well that we haven't yet seen that panic sell-off that we really need to see to have a little bit of confidence that the bottom is closed. Although this is something I talked about before, I'll bring it up again here, that we're so focused on this sell-off, this panic sell-off. And remember, we're not the only ones looking for this or expecting this. Every trader that's been around long enough knows that that's usually what happens. You get a panic sell-off, and then usually that kind of signals where the bottom is. I have this feeling that because so many people, I just know that the market tends to not reward the crowd. It tends to punish the majority. And I just have this feeling that we're going to get a panic sell-off at some point, and everyone's going to say, oh, there it is. We've got it. Now is the time to buy. We're at the bottom. And remember, the characteristic of a market bottom is that when you're at the bottom, nobody wants to buy. Nobody is confident to buy. It is, you're afraid to buy. It takes a tremendous amount of effort to buy in at a bottom, because it just doesn't feel like you want to buy in. In fact, not only does it not feel like you want to buy in, anyone you talk to is telling you you're crazy, or it's too early, or we still have a lot further to drop, or it's too scary to get in. It's just, that's the feeling. And so I just have this I just feel like we're going to get a panic sell-off. Market's going to start to rally, and everyone's going to think it's over. And then we're going to get another one that starts to really shake everyone up, like, oh crap, what do we do? Where is this thing going? How far are we going to drop now? I just think that there's that possibility we could see it. Now, again, I'm not trying to be psychic here or tell you, try to assume that I know what's going to happen. I'm just, again, sharing my experience and then observing. Anytime I see a lot of people agreeing or feeling confident about a certain outcome in the market, it usually isn't going to happen. And because again, the market it just doesn't have a tendency to reward the majority. It has a tendency to punish the majority in some way or form. And so I've over the years, I've just looked at the opposite. Okay, how is the market going to punish this group that's getting too bullish or getting too bearish or what have you? And sometimes that's a curse, because it forces you to kind of look at to look at the negative outcome instead of the optimistic outcome sometimes. But it's just, that's how the market seems to work. It seems to work that way. All right, so let's go here. This is another glitch that I noticed, was that you see that we had one rally day and the sales went from extreme all the way down to crossing over. I think that doesn't look right, so I'm assuming that that's a glitch too that's being worked on. I have pointed this out to the management team, and they're working on it. We do know that it's come down probably quite a bit with the rally over the last couple of days, but I don't think it's come all the way down that quickly in one sharp move there. But we do know that this rally is alleviating that oversold condition that we're in. Sentiment indicator is working. That we didn't quite get to the oversold range down here, but we don't have to do that. And again, we're assuming that this is a rally setting up for another move down at some point. Could it last a few more days? Yeah, it could. And as we saw last week, you could start to see it move sideways a little bit. And sometimes, to alleviate an overbought or oversold condition, the market doesn't have to move in the opposite direction. It can just move sideways for a period, and that could alleviate that condition as well. All right, let's get to the charts. And look at a couple key areas here. So this is what I was talking about on Friday. We've been bouncing along the support level. I said, if we break this, we could start to see, the kind of the panic selling. You're just taking out that low. This gets back to what I was just talking about earlier, though. Is that a lot of people were thinking the same thing. A lot of people were thinking the same thing as me. Is that, hey, boy, this is a key level. Again, these levels are not. Anyone knows how to read a chart can see these levels, and they know the significance of support and resistance and all that. So we saw the market kind of surge into the close there on Friday. The VIX didn't really move up a whole lot though with it. So that's one thing that concerned me a little bit. But you had you had some other dynamics going on Friday, as I mentioned on Thursday, which was that Friday was not only the end of the month, but it was the end of the quarter. There's a lot of buying and selling decisions that happen around that period that may not have a lot to do with long-term expectations. It could be that you remember all these fund managers, they've got to provide their clients with these quarterly reports, what they're buying, what they're selling, what they own. And, a lot of clients freak out a little bit if they're owning, little XYZ startup tech company that they don't even know what they do or don't know, they don't know anything about it. What they want to see Apple, they want to see Amazon, they want to see these companies that they know and they hear people talking about and they're aware of them, they use their products. So a lot of times what these fund managers do, they may not make a lot of money with some of these big companies that everyone knows, but they make it on these smaller companies that grow very, very quickly. And so a lot of times at these end of the quarter periods, they'll get out of some of those small cap names and get into the larger cap companies. And so you'll see a lot of selling on the small caps, a lot of buying on the Dow stocks and the big well-known stocks. And then it'll reverse after that quarter ends. So they can show all their clients they're holding these big companies, but then they switch back to the companies where they're really making the money. And there tends to be, I'm generalizing all this, but there's a lot more to all this, and there's a bigger dynamic here. But you can see that selling and that buying have nothing to do with what they expect these companies to do over the next 12 months. It's everything about getting that quarterly report to look good. They call it window dressing. They want that quarterly report to look great to their clients, and then they switch back. And I'm not saying this happens immediately or the very next day. It can be a gradual process, but this does happen, and so you have to be aware of that dynamic. And so, I think that could have been a little bit of what was causing some of the selling that pushed us lower on Friday, and then some of the buying that happened on Monday and today. We've kind of reversed that now. We also know the market is very oversold. We were due for a bounce. We thought it was going to happen back in here. It didn't. We turned around and went lower. So it's not shocking. It just happened a little bit later than at least from what I was expecting. I was expecting it to happen right here, and it made sense because you're bumping into that support level. You have a bullish day right here. It looked like it was going to just take off. But this is what can happen. This is what I was warning you that can happen. Is those rallies are very sharp. Yesterday's rally, today's rally have been big rallies. That is not a sign of bullishness in the market, by the way. That's a sign of exactly what happens in these rallies within the downtrend. That's why they call it a rip, is because it rips higher and then it reverses. Some of the biggest up days in the market history have happened in these rallies within downtrends. What's a better signal of a bullish upward move is when there's smaller increases, but there's more of them. You get more of the gradual day by day increases, and it's a little bit more stable. You're not seeing that volatility, these big moves up, big moves down. That's usually a sign that you're in a bearish trend when you see that type of volatility. All right, so how much longer do we expect this to go? Well, remember, as we've seen, is that sometimes when we draw these lines, everyone that knows how to read a chart and draw lines can see the same thing. Maybe the market throws a little bit of a curve there and goes beyond some of these levels before reversing. So we'll keep that in mind, that the market is trying to trick people right now as best it can. But what jumps out to me is this: you within this downtrend, you now have a trend line that you can draw. I know this isn't the straightest line, but that can work for now. There's also a horizontal line that's right in this area right here. You've got support back here, support, resistance here, support here, support here. So this is significant resistance here. This is a significant area right around that 388. And it's pretty close to lining up with that downtrend line as well. So we're going to say 388 is going to be a target area here. That would mean that we could have another day or two, and we don't have to get up to that level, by the way, but that's the one that stands out, because the other one would be if I drew a line across here, and we're already above that. Now, if we were to fade, if we sell off into the close and come all the way back down and move below this level at the close, that could be it. We could be ready to move lower tomorrow, because that would create a very bearish looking candle, and you're back below that resistance level, and that would be a very bearish move. But because if we close where we're at right now, I don't see anything that would cause it to reverse right here. Now, again, we all of us that know how to draw these trend lines are probably looking at the same thing, and it could be the market does reverse right there, so that none of us are ready for it. But usually it would give us a clue it's going to even do that. Maybe a gap up tomorrow that then sells off, gives us a bearish candle. If I see that before we get to this level, that could be a signal that it's going to reverse earlier. Hopefully, it gives us a signal. Lately, the market hasn't been giving us very strong candle signals, which is why, for me at least, it's very difficult to read, because that's how I read the price action, is through the movement of the formation of those candles. It tells me what's likely to happen, and I rely on that, because the probabilities are usually pretty high when you get those candles. And I've taught a bunch of them to you over the years, and we'll continue to. But we just haven't been getting a lot of those. We didn't really get a bullish reversal candle down here at all. It just moved up yesterday. And the way it closed yesterday, it didn't close very strong yesterday, and I believe the volume, let's put the volume up there, the volume was pretty light. There were definitely, the volume was here's where the volume bars were the last few days, and then here's where it was on yesterday. It was lighter than the average volume or the recent volume. So we were rallying on light volume. That's usually a sign of short covering, that there wasn't a lot of real buying going on, but a lot of just buying that was related to people covering their short position. They were bearish on the market, but they were closing out those bearish trades. That requires them to buy back the shares. And so if you hear of a short covering rally, that's what's taking place. And that had all the indications that's what was going on. But then obviously we've gone higher today. Now, what would be the move today then? If yesterday was short covering, what's going on today? Well, you have a combination of things today. You have continued short covering because there's some people that were covering. There's some people that were covering their short positions, and that's what caused it to rally. But there's also others that remember this day where they covered their short positions and it went right lower again, probably expecting the same thing to happen. So they probably didn't close everything out. And then today it jumps up higher. Now they're having to close it out quickly. There's a different mentality when you're short a stock than when you buy a stock. You can't let the trade go against you. You know, if I buy a stock at $50, that stock can go to $1 and my broker won't care. There's no obligation that the broker has. But when you're short a stock, you're borrowing those shares from your broker. You've got to replace them. You've got to buy the shares back and give them back to your broker. And so you can't, the broker won't let you have a trade go against you further than what you've got money in your account to cover your position. And so there's huge, massive losses you could incur if the trade goes against you when you're short. That's why I don't recommend a lot, particularly new traders, getting into shorting stocks until they really understand what they're getting into and what they're doing, and they can trust themselves to stop out of trades when they go against them. But so there's a different dynamic that's going on, and so this is a combination of other people covering their shorts, but there's also now buyers coming in, and usually these are the undisciplined buyers that see now a stock like Apple. You know, Apple was dropping and they wanted to get into it, but they didn't want to. It kept going down, and everyone was talking was bearish on it. Hold on here. So yeah, it's not affecting. There we go. So, you know, they're waiting to, and yesterday it reversed, and you know, they thought about getting in, but they remember right here where it reversed and it went back lower again, and then today it's up again, and so they're chasing it. They're wanting to get. They're afraid they're missing out on the move. That FOMO, that popular term that's thrown out there now, fear of missing out, FOMO. That starts to take place here in these early stages, or in these snapback rallies. People now assuming this is the bottom, we're going to go straight up from here, and they start chasing some of these moves. So I think that's a lot of what's going on too with today's move. And then what you start to look for is, does that start to slow down? Because if those are the only ones getting in, first of all, if those are the only ones getting in, those short traders, they're not buying back because they're holding these stocks for they expect them to go up. They're buying back to close their position, so they're not doing any more buying once they're out. These undisciplined traders now are also the ones that, as soon as that stock turns on them and they're losing money, they're going to be really quick to sell. And so that's why you get these sharp rallies and then you have a sharp reversal. Now, if this lasts a while, what could be happening is you could have fund managers that are putting money in, and there's could be actual real buying going on. But that's what you'd start to look for. You start to look at is the rally broad based, a lot of stocks participating in it. Are you starting to see the leadership stock? This is a good time to really pay attention to the chip stocks, the transportation stocks. Are they leading away higher? Or they look like they're forming more bullish trends and having strong bullish reversals. That can tell you quite a bit as to whether or not there's big fund managers that are starting to buy at that point. We'll start to see the VIX come down quite a bit. That's something to look for. All right, so for us though, at least for now, we're gonna pay attention to our trend lines. Draw those in again, right about that 388 area. Just give kind of a general area there. We'll see if we rally up to that point, and then what do we do at that point? Does it roll over? Do we get any sort of bearish signal there? We'll see what happens. But in the meantime, that we might be able to have a few trades. If it is going to continue to move higher, we could maybe find a few trades to profit from it. By the way, today was kind of, I was still thinking there's possible yesterday's rally could be a false move. So I kept some of the inverse ETFs in the portfolio that were hedging a little bit. I got out of those right at the market open when we gapped up though, because there was a stronger probability that this was going to keep moving higher at that point. So I didn't want to be holding those, continue to hold those if the market was looking more like it was going to rally for the next couple of days. The other index is the same, although again we could look at NASDAQ. You start to see the NASDAQ outperforming the other. Technology tends to be a leadership type group. You start to see a stronger performance and a bigger percentage move by the NASDAQ 100 and the Russell 2000. Russell 2000 is the small caps. If you see it moving up a bigger percentage, which it is today, it's up 3%. So it's up 3.25%. NASDAQ 100 is less than 3%. Dow is only less than 2.5%. S&P is about 2.5%. So you're seeing a big outperformance. What I was looking at was right here. What you're seeing is a big outperformance by the small caps, which is that's kind of a little bit of that risk on type signal there. And that would be a pretty good. That's a pretty good sign. You want to see that continue though, and be more than just a one-day type move. That's something we'll keep an eye on as well. Maybe what we see is the Russell breaking out of its range. And it's a little bit closer to its range. Maybe it starts breaking out above there, and that could be a sign that maybe that this could last a little bit longer. Now let me go back because this is important in context here. Because one of the things that we were looking at recently is the longer term perspective. And one of the things that a couple of the things that we were looking at, possibilities, especially when we were right in this area right here, and we were getting this little rally up right here, was that this could be a wave A. Well, first of all, this could be wave A, this could be wave B, and we could be in wave C. If this rolls over and drops again and we get back below that low, that June low, we could be trying to complete that larger ABC correction. But there's also a tendency in that wave B, in this area right here, for it to be more of a corrective type move, more choppy, more sideways. So another possibility is that this could be wave A, and this could be A of B, this is B of B, and then we get a rally up into this area for C, and that completes that wave B, and then we have a bigger drop after that. Now this would push us into next year probably before that bigger drop takes place. But this could make sense if this is more than just a short covering rally. Then this could make sense that we're moving into a more bullish time of the year. Typically, not necessarily October. Some of the biggest market crashes have happened in October. So, if we're expecting a panic sell-off, this is the month to be in for a panic sell-off. But November, December tend to be more bullish months, and so if we do rally and we're not dropping lower here, right at this area right here, that could be what's going on. Is that maybe we're rallying into the end of the year, and it just creates that wave B, or the end of that wave B, and then we have that larger wave C. The problem with this is that it means that we're probably going to have to push out before we're going to be aggressively buying again. We're going to have to probably expect that we're going to be having to wait until into next year before we start doing that, and so that it's almost like at this point you want to just get it over with. Rip the tooth out for heaven's sake. Just let's have the painful event and get it over with. That's kind of where I'm at right now. It's like, let's just get it over with so we can get back to bull market conditions, which is always more fun to trade. But that if we rally up beyond these levels that I was pointing out, here was that resistance area right here. If we start breaking out above that, then this would be the expectation is that maybe this is just a completion of wave B, and then we're going to roll over and drop. Now, again, I'm not saying that's what it's going to do, but again, we want to be prepared. If we start breaking out above this area right here, I don't want to be sitting back saying, well, what's going on? I have no idea. I feel like everything's a coin flip in this market. No, you don't want to get to that point. You want to look at, okay, what else could be going on? And it's all related to trend behavior. Typically wave Bs tend to be more choppy. So you get wave A that comes against the trend, very sharp a lot of times. Wave B often will be sluggish but choppy, back and forth. And then you get another sharp move for wave C, and then the trend continues. So that's kind of the behavior of an ABC pattern. By the way, if you want to learn about ABC patterns, go to Traders Pro page, type in Traders Pro ABC patterns in the search, and you should find the recording I did, the training I did on ABC patterns. I go over all this, explain the characteristics of those patterns. And once you understand those characteristics, then you can look at the different possibilities. And that's what we're doing right here. Now, in order for that to work, we really can't drop any further. The fact that we dropped on Friday makes this outcome a little bit more murky and less probable, although it could still happen. You can still, if this is wave A, wave B, wave C of a bearish ABC pattern, your wave B can go a little bit beyond the beginning of wave A right here, just not very much. You don't want it to go very much beyond that. And so we can't go any lower. If we go any lower, then I would assume then that this is wave A, wave B, and we're in the wave C. This was a rally within the downtrend, and that's the next move down if we break back below that low. But that helps because now we know, and this is kind of obvious. It's stating the obvious, but I pointed out the resistance area that's important for us up here, but this Friday low is going to be important. If we roll over and drop back below that low, look out. I think we're going to get some pretty big down days at some point if it gets back below that low there. All right, let's skip ahead to the other indicators here. Bonds have tried to rally a little bit recently. Well, you could probably call that more moving sideways. We have seen some of the bond yields come down a little bit. Now, the trend is still down. I think that's important to continue to read. There's all these reasons you hear about why bonds are trying to rally a little bit, and are they going to keep rallying? And is this the bottom of the bond sell-off? Um, well, let's just let the chart tell us that. Okay, the key area here is going to be you've been going lower highs and lower lows. This right here was the last lower high that jumps out prior to going to a lower low down here. And so this is going to be a key area. Now this also lines up with this support area over here. So that makes this area right here at 107, around 107, 108, maybe right in that area there, very important. If we continue to rally, we break above that, especially if we move up very sharply and more impulsively. That could indicate a potential trend reversal. That'd be the first signal that maybe that'd be the first time you should be talking about bonds reversing, possibly reversing the downtrend. If you're talking about it right now, it's too early and you're just speculating, and there's really not any sort of probability that I see that would back that up. Now we could rally up a little bit further. This could be just wave A, wave B. We maybe rally up a little bit further for wave C, stay below that resistance area, and then that leads to that next move down. But I'm assuming that the trend is going to continue to move lower until we see it change that. So the key areas then, this area to the downside, if we break below that, obviously we're continuing the downtrend. That's stating the obvious, but this area right here is going to be key around that 10. Let's say 108. That'd be clearly then above that area, and that would be where we need to at least have the discussion of talking about a possible trend reversal. But I would throw out again, how does it get there? Because if it gets there, if it keeps moving real choppy and sideways and gets there, that's a corrective type behavior. I would expect it to still have another move down, or still be in danger of having another move down. If it moves up there sharply, then you could be talking about it'd be a good point to talk about a potential trend reversal at that point, or at least start to look for it. Gold has made a pretty sharp move. We were back in here last week, and it's the same old thing. We're trending down every time it seemed to rally. It seemed to roll over, but there's a lot of activity going on now, in particularly the gold miners. You're starting to see some of those charts looking like they're turning the corner. Could start to look a little bit more bullish. The dollar was coming down. I said in order for the gold to rally, you'd have to see the dollar start coming down. We'll look at the dollar chart here in a second. But again, what do we talk about the dollar? It's getting too extended, too far, too fast. It's gotta alleviate that, and the way to do it is for it to pull back or to move sideways, and it's pulled back pretty sharply in the last few days. So if you don't know this relationship, there's a tendency for the dollar and commodities to move in the opposite direction. Doesn't always work that way, so you don't latch onto that as a law. It's got to. But if the dollar goes down, typically oil and gold and corn and wheat and other commodities start rallying or tend to have a tendency to go up. The reason for that is they are priced in dollars throughout the world. That the dollar is the world currency that people use for commodities, and so it tends to have that inverse relationship. But it's important to understand that, because again, if you're looking to get into a gold stock or an oil stock, your chances of that trade working out are going to be much better if the dollar is falling, not if the dollar is rising. And so that's something you would want to take a look at with one of those trades. Any trade involving a commodity, you'd want to go look at the dollar chart. And that's why we cover it in class, because it does affect a lot of areas of the economy, and there is that dynamic relationship out there. So if you're wondering why we talk about it, that's why we look at these things as because they tend to have an effect on different segments of the economy. Here's the oil chart. Oil's been moving up sharply. Now, there's a lot of different opinions on oil. A a lot of the rally this week that has been attributed to OPEC having a meeting where they're going to reduce supply. Now that's going to be something that that's why it's hard to get bearish on oil right now. You've got a worldwide demand that's there with the whole Russia-Ukraine thing. That's a no-brainer. Everyone's aware of that. But you also have this big cartel, basically, that can turn on the faucet or shut it down as they like, and they're going to do it based on their own personal self-interest. If they can keep oil prices elevated and they're going into wintertime where there's huge demand, they know they can make a killing. And they don't care who gets hurt. Obviously, there can be political pressures put on them to try not to do that. But it is a dynamic that if you're going to short oil here, you think that the oil is going to go down because there's going to be an economic slowdown. Now, again, I'm not an expert in commodities, so I don't want to try to. I'm going to go off of what the chart is telling me. But some of the things I have heard recently, which I think is interesting, is that there's one trader that pointed out that does specialize in commodities that said a lot of people assume that when you get into kind of a recession that that oil, the demand for oil is going to decrease, which it does. He said it does decrease, but it doesn't decrease to the amount that a lot of people think it will, because we still have to drive our cars. It is we got to drive our cars whether the economy is good or bad. And now the idea is not that we're going to be driving less, but that there's less energy going into manufacturing or what have you, or other things, areas of the economy that creates that less demand. But he basically said, though, there is a slowdown in demand, but it's not as dramatic as a lot of people think. So there's a tendency to have an overreaction where the market sells off, assuming that oil demand is going to go way down, and then they realize it didn't go down as much as they thought, and it comes bouncing right back again. So I don't know if that's the dynamic that's going to play out here. All I know is that a lot of the oil stocks, especially the individual stocks, have held up pretty well during this latest sell-off. Maybe not necessarily the whole chart of the USO, but every time I look at the long-term chart of this, I see potential that this is a larger ABC correction. The only thing that at least recently that I've been trying to look for is when is this actually going to bottom out? We were drawing the same pattern back here. It started to rally a little bit, then it rolled over. Is this the same thing going to happen again? We're not at the wave C yet. We're waiting for wave C. I'm not saying that oil is bottom, but it looks like this is a larger correction of this trend. And so, and I don't think until the Russia-Ukraine thing gets, ends, I think this is going to, especially going into this year and this winter season, where there's going to be just huge demands all across Europe for energy. I think you want to own, natural gas, coal. If you're not owning actual oil like Chevron or ExxonMobil or something, at least some of those other areas, especially natural gas, where there's going to be that huge demand. Now, that's a crowded trade, I think. A lot of these stocks have moved up pretty sharply, especially recently. But that's what I'm looking for. Is this the end of a correction right here? And are we going to start to see a move up? Now, we're going to need to start knowing what we're paying attention to then here. Just this last drop, there was a lower high, lower low. This was the last significant lower high prior to this lower low. So that's the key area right here. Do we move above that? You could draw a trend line down through here as well. That probably lines up in about the same spot right here. But that would, especially if it continues to move up sharply like this, and looks more impulsive, so you get impulsive down, impulsive up. And then when it does pull back, it looks more sideways or corrective. That would be a signal that maybe you're reversing back into an uptrend there. But just, we'll pay attention to that. It's just in one of these areas here where it could start to rally. We'll see if it does. But like I said, it is some of these oil trades are crowded trades, and when there's a lot of people that are assuming the same thing, it's obvious that there's going to be demand for oil. Again, what does the market tend to do? It tends to not reward the majority of people, especially when something seems like it's obvious and it's a no-brainer. It's guaranteed to happen. When it feels safe to get in, it usually isn't, right? And so that's something that if you're doing some of those trades, you still better quantify your risk and stick to your stop losses, because there's going to be it could, the obvious may not be so obvious. There could be dynamics that come into play that could burn some of those trades, and it'll drop very quickly if it does, because if it is a crowded trade, everyone's going to go for the exit at the same time. There's a comment here. Yeah, uranium is another one that's really going nuts right now as well. Another commodity. All right. Here's a chart of the dollar. And you can see, again, we got to that real stretched area. Now, this was, again, we were talking about this. This was a little bit of a warning that, we had an up day right here, and then a little bit of buying exhaustion here as it tried to go higher, but it couldn't. It doesn't always pull back right there, but that was the price action was suggesting that it was getting a little bit stretched and it's having a harder time going higher. You get this sharp drop right here. It paused for a couple of days, and then we've seen a 2-day drop right through here. Could this just be an A, B, C pullback? We're pulling back now to previous breakout areas. These are other key levels here to keep an eye on. But that's a big part of why the markets have been rallying. The markets have been looking to get a weaker dollar. Commodities have been looking for a weaker dollar. Now, is this just a pullback and it's going to start going up again? We'll have to see. These previous breakout levels, we're looking to see if they hold a support. This was the last lower high right here. So, to really break to a lower low, or excuse me, higher. This is the last higher low. Excuse me. This is the last higher low right here. So to break to a lower low, that'd be a pretty dramatic move down to do that. But we want to see how it reacts to these support resistance levels. Do they hold? Or if it doesn't, it gets below that low right there, then you're talking about a trend reversal in the dollar, and there's that could be another reason why oil would have a very high probability of going up over the next few months if that were to happen. The VIX still elevated. Let me go to again, I've been pulling in the VIX chart. We can look at the VIXY on Traders Pro, but this is the actual VIX, which you can't pull up on Traders Pro. We're moving back below 30 right now. This line is 30. So the volatility has decreased, and we're kind of out of that area of concern. But again, based on the chart, our analysis is already done. This could just be that rally with the rip within the downtrend. We're going to want to see if on one of these down days, if we get another down day here soon, do we see that VIX start spiking back up? 40 though is the area that would indicate panic. And we're not there yet. But again, I keep pointing out, we can get there especially when we're above 30, we can get to 40 very quickly. It wouldn't take much. It could happen in one day. We can get these massive moves, these massive spikes in one day that can really and these weren't panicky days really, but they were big moves in the VIX. But it can happen very quickly. But that's the sign that's at least the initial sign that we're at least getting a panic sell-off, is if we see that VIX get up above 40. Some other charts to keep an eye on. Again, I talked about the chip stocks. They're participating in this rally. You'd want to see continued strength in that. If you see a bearish reversal candle after a 2-day rally, then don't ignore that. If the rest of the market's going higher, but chip stocks are lagging, they tend to be leading, and so if they're lagging, that's something we want to pay attention to. But by the way, you never want to make a trade just based off of that dynamic. This is we're just looking at general signals that are telling us whether conditions are looking more bullish or bearish. That's typically a bullish signal when chips are leading the way and leading the market. But and some days it's not telling us anything. It's just telling us, like today, it's just telling us the market is rallying and chips are participating in that rally. I'm not seeing any sort of major signal there either way, bullish or bearish. Bullish in the sense that it is participating with the market. That would be a bullish sign. It's not lagging it, but I don't see anything dramatic today that would tell me, oh boy, this is going to last for several more days, or this is going to reverse tomorrow. It's not showing anything that would be that dramatic. Transport, same thing, solid up day to day. In fact, they're trading at highs of the day, which would be a pretty good sign there. Getting your participation in the transportation stocks. Bitcoin is rallying a little bit today, but it's still in this decline. It would have to get to above this high right here to get to a higher a higher high. This is a lower high right here. And I just think it's going to have a difficult time doing that. And then the high yield corporate bond market has really been focused on this. It's up today. But again, could this just be wave A, wave B, wave C, and it rolls over? So, it's getting up close to a pretty significant support area right here. You'll have to see if it can break above that. Some things to look for here is you see the market going higher and the HYG actually going lower or sluggish, flat. That could be a little bit of a divergence sign to look for as to whether to trust the continued rally or not, especially if you see it down. But I find it hard for it to be down because the market is focused on it right now. I find it hard to believe that this would be down and the market would be up. But there could be segments of the market that are still up, that are showing that the index isn't down by much. This could have a down day and the indexes could be flat or something like that. But we do want to pay attention to this right now because the market is. Until it stops paying attention to it, we'll keep including it in the market update. All right, real quickly here. So again, overall, what's the wrap up here? Overall, we're in a bear market. Looks like a bear market rally. We're looking at these resistance levels to see if they're going to act as resistance, and we're going to have another move lower. Could we add some bullish positions in this environment? Yeah, we can, and especially since we'll hedge if it starts to look bearish. But we still want to be mostly in cash because we're still in this overall bear market condition. So on the portfolio, I did let's take a look at those. I did get out of the SQQQ and the SARK. I got out of the chip stocks yesterday on the open. The SOXS, the inverse on the chip stocks, because they looked like they were going to go higher. So I got out of the hedges. NOC off the highs today, so it's not looking great today. But overall, it had a good day yesterday. Moved up. Now again, my stop was below these lows right here. We did get below my stop, but we didn't close below it. And so I'm still in this trade. I still held on to it. Tesla, I did the same thing with Tesla, but this tells you why, again, no matter what stop loss plan you work or you use, it's not going to be perfect. I like a close to get a close below the lows there. And on this day right here, now this faded really strongly right at the close. So but for most of the day, it was trading above the lows. So I ended up holding it, and then it gapped down on that news. I got out right at the open, so, but I ended up losing a little bit more than I was planning on. So sometimes in the case of NOC, it worked, it bounced back. In the case here, it gapped down, and well, you just hope. And I hate it when there's news that gaps a stock because there's nothing you can do about it. It happened overnight. It gapped down, but it happens. That's why you always have to be aware that even though you set these stops, they're not guaranteed. And that's why. But remember, going into the trade, I calculated what I'm willing to risk. And I have a range of what I'm willing to risk. I know there are going to be a few times where it ends up being more than that. But that's why I want to get the level down low so that if I do have that a couple times where it happens, it doesn't kill me. And I don't want to have so much exposure, all my money in one stock to where a big gap like that could ruin me. But you're going to have that. You're going to have earnings reports that don't go your way, that the stock completely reverses. It wipes out 6 months of gains in one day. That's going to happen. And so we can only control what we can control, but that's why it's important that you control what you can control. You got to be as disciplined as you can, to where you're balancing things out to where, a move on one or two stocks isn't going to ruin you. All right. So again, looking at the SARK, again, it gapped down at the open here. I kept it yesterday because it was still looking like it could move higher. And again, I still didn't know if yesterday's rally was just going to reverse like immediately, like it did the time before. I want to keep that hedge in place. But these drops were pretty sharp on both the SARK and the SQQQ. I always hope on these that I get a little bit of a signal that they could be reversing, so it doesn't. But it gave back a lot of the gains that were created, and in some cases they turned into losses. SARK was another one I got out to right at the open. And so basically we're still sitting right around that 132,000 level. We really haven't gone anywhere. We've done all this work the last week, but didn't really go anywhere. That's exactly what bear markets are like a lot of times, especially if you're just doing this hedging stuff. It can be a lot of work for very little money. But it gives you something to do. So it gives us something to do while we're waiting for the market to bottom, and we're just trying to see if we can grind out some gains. We have managed to grind out some gains. We were down at 120,000, a month or two ago, and we're up to 132. So we're grinding out some gains, but it's been kind of a little bit of a slow process lately. NOC. So I talked about this one. This one still looks pretty good. Let's look at the other ones. LNG is our natural gas trade. It's still been going up. Again, this was based off of this potential bullish ABC pattern. We'll see if it can break out of here. It may move sideways a little bit when you get up to these breakout areas. Sometimes they pause a little bit, or even may pull back a little bit. Who knows? Especially if the dollar rallies a little bit, you can see it pull back a little bit. But I want to. My stop's down below here, so hopefully it's giving it enough room to move up over these next few months, continue to move up over these next few months. Marathon Petroleum, MPC, is another oil trade up really nice today. This was based off of the potentially a bullish ABC pattern right here that created a higher low. We're getting close to getting to a higher high. We're not there yet. This is pretty much equal high. So this is a pretty big run for the last few days. It could pull back a little bit right here. But I'm going to give it that space with my stop down below here and give it a chance to kind of maybe move a little bit sideways before going higher. That's probably as much oil exposure as I want, because now if I'm getting into new oil trades, I'm kind of chasing right here, which I don't want to do. All right. Individual stocks, under the sectors, I still like aerospace. And what you can look at here under aerospace is you're looking for some of the more well-known companies that have pretty high strength ranks. Some of them are just going to hold signals today, but they're still showing that they're still under the sell, because remember, this updates overnight. So if you look under the sell section here, you'll find Lockheed Martin, LMT. It's right on that borderline, 89 strength rank. I like to see it at least above 90, but it's right there. And you're probably waiting for confirmation anyway on these. So they have a chance to move up to a 90 strength rank. Let me switch this to signals here. Ooh, it wasn't a hold signal. It's faded a little bit now. I have to see what the market looks like here. But I like the fact that if it can rally up from here, it looks like it could be putting in a higher low. You'd want confirmation on this. So either wait for it to go back to a buy signal, or at least, get up, move up a little bit further for the next couple of days. I'd probably wait for a buy signal just in case this is just a rally within the downtrend. But I'm anxious to get back into a lot of these defensive stocks. I think they're going to be money makers for the next couple of years at least. And then the other one was the other aerospace stock was General Dynamics, GD. Oops. The sell section right now. There we go, General Dynamics. Again, 89 strength rank, but kind of almost the same chart. Looking at this as possibly putting in a higher low right here. This has a stronger move today. It's up today. Moved clearly at a hold signal right there, but you could wait for that to go back to a buy. It's going to take a little time to go back to a buy. You can see up here, it's kind of on the left side of that hold range. It needs to. So you can, if you watch this bar up here, you can tell when it's getting real close to going to a buy signal. And then consumer staples, again, these are stocks that are been outperforming lately, and they would outperform in this type of economic environment. Hershey's, we mentioned a few times. I like that chart. Well, that chart looks interesting because it looks like a real subtle possible inverse head and shoulders pattern right here. Be nice if it could break out above here, though. So if you want to wait for a little bit of confirmation and wait for it to go back to a buy signal, let's see how close this one is to going back to a buy signal. A little bit closer. It's in the middle of the hold range right there. Another one in this group, General Mills, GIS is the ticker symbol. 94 strength rank. I really like this one. It broke out to new high, pulled back, kind of an ABC pattern. Looks like it could be putting in a higher low right there. Looks like it might be, it looks like a potential buy signal right now, whether it's faded off the highs though, so whether that holds or not. I'm going to add this to the portfolio just to give it a little bit more balance. Now, I don't love the price action today, but this allows me at least to be able to do the trade in class. I try to do as many of the decisions in class as I can. I wanted to get out of the inverse ETS in class today, but with the gap down, with them gapping down at the open, if I waited, as you can see, if I waited till class, I would have lost a lot more money on those. So I didn't want to do that. But I'm going to go ahead and get in, and I'm going to put a stop down below here. And I'm going to put it just at around $76. That would also, I think, get it below these highs right here, over here. I think that'd be a good spot. You could put it down here as well if you really want to give it some room. I don't want to risk a lot though here, because if the market's going to rally for a few days, it's going to happen right now. If it reverses and this comes back down, and I get stopped out, I don't want to lose very much. And if the market does reverse, I'm going to go back into, maybe not all the way into those inverse ETFs, maybe just the SARK and the SOXS or something like that. And I'll be jumping probably back into those. Hopefully we don't get a reversal before Thursday, where I can at least talk about it and show you. All right, let's get into this one here. I got to wrap things up too. I'm going way late today. Stop at 76. I'll just go with 100 shares. 100 would be about almost 8,000 in the trade, and the very little risk. If I'm wrong, I'm only going to lose $227. So that looks good to me. Let's go ahead and get into that. And then the last one under consumer staples was JM Smucker, SJM. Looks like a nice corrective pattern starting to move up from that. Again, wait for it to go to a buy signal. A little bit of confirmation would be good. 91 strength rank, a little on the lower end, but not too bad. All right. That's all I have. Have a great week. See you on Thursday for the stock specific class. Bye now.